So I was watching this video this morning about it was a guy reviewing somebody else's financial plan, and it's one of those where if you invest $800 a month for 10 years when you're young and you never invest another penny again, then you wind up a millionaire. And the guy's criticism was like, yeah, that's true given the math that was in the video, but you're leaving out inflation. And if you have, that's very different than $1 million today because of inflation, which is a perfectly valid point. So when you're doing those super long range projections, you got to keep that kind of stuff in mind. But it got me thinking. I had this idea that the money supply, usually I represent that with M2, and that's a broader money supply metric, and it includes bank deposits and all that kind of stuff. So the M2, if you track that over a long period of time, you'll see the monetary growth rate, and that will be the overall inflation. But then I was thinking about purchasing power parity and or PPP as it's called in the economic circles. And that's okay. If you're doing those long range projections, you probably want to know how much of the money supply is like the average or your share or however you want to look at it. It's an interesting idea because it gives you a sense of, are you ahead of average? Are you below average? Is your personal lifestyle and your personal experience of inflation representing the whole, or are you doing better? Are you doing worse? Now, obviously, doing super long range population projections is difficult in a country like the United States because we have so much migration. So it's definitely an open question as to what the population will be in 2050. But there are projections out there that you can look at. So I just decided to go to the Fred, as I often do. Let me share my screen here. This is the St. Louis Fred. Here is the M2. This is the non-seasonally adjusted, and it's in billions of dollars. And it updates every week. And apparently this particular data series goes back to 1980, which is plenty sufficient for our purposes here. Right now it's at $20.8 trillion, almost 20.9. And that's a lot of money. You can see here all the money that was pumped into the economy through the COVID stimulus and the increases in real estate prices and all those kinds of things. Because the people who bought up all the houses during COVID, mostly they're not paying cash, right? They're financing those. Those mortgages create new money in the system. Those get added into M2. So a lot of this is actually real estate, but then direct handouts to individuals by the government, plus all the business bailouts with the PPP and ERC and all that kind of stuff. So it's a lot of money. So pre-COVID, February of 2020, 15.3 trillion. And then depending on where you want to cap it off, but like end of or middle of 2022, 21.6. So from 15 to 21, that's a lot. That's a big chunk of increase. And it's no wonder that we have seen the consumer price inflation over the last couple of years that we have. It's important to remember that inflation is not a rising in prices. Rising in prices is an effect of inflation. This right here, this increase in the money supply, that's what inflation is. It then goes out into different sectors of the economy. And if it goes into assets, people usually like that. If it goes into houses, if it goes into stocks, if it goes into business valuations, people are all happy. The economy's growing. But when it goes into consumer goods, then people say, oh, the cost of living is going up too much. It's important to keep your terms straight. This is something that has been deliberately obfuscated over the past many decades, because if you just know the root cause, it's much easier to see what the issues are. And that does not behoove the people who are on TV talking about it. Okay, but let's take a look at the working age population. So the working age population, so yes, old people who are retired do have money, but for purposes here, I just decided to look at the working age. It's going to be a proxy measurement of the two. And so this is population going back to 1960, 101 million back then. And then on and up. And looks like we had a little bit of a dip here. 206 in 2018, 2019. We got as low as 205, and now it's back up a little bit. So those will probably be subject to revision over time because they look weird compared to the rest of the data series. There's a couple little bumps here and there. But yeah, definitely an odd bump there. This is just how it was. If we're thinking back 15 years, in 2021, there have been 2006. Were a lot of kids born in 2006? I don't know. Compared to those aging out at 65, whatever. So what happens when we divide these numbers? So let's do that. So I'm going to grab this data series here, copy that. I'm going to edit the graph. I'm going to add a series there. That's going to be line B. And okay, so we got line A here, M2, billions of dollars. And line B is working age population, and that's in actual numbers. So that does not require modification. So what I'm going to do here, I'm going to do A, which is the M2 times a billion. It's 1,000, that's a million, that's a billion. And I'm going to divide that by line B. That's going to get the money supply per working age person. Let's apply that. And here we go. So back in 1980, that was $11,000. And over here in 2022, that's $104,000. And right now we're at 99,000. That is super interesting. So what you might be able to say with this is that the average working age person's share of the economy is going to be $100,000 per person. And back in 1980, it was $10,000 per person. Now, obviously, there's a big. So I was born in 1980, and I have seen a huge shift over time. So I remember watching daytime TV while I was a kid, probably eight, something like that. So somewhere in here, 1988, 1987, somewhere in there. And there would be commercials on TV for getting your CDL, your commercial driver's license, so you could drive trucks. And there would be a whole bunch of these different kind of vocational sort of training schools that would say, come with us and we'll guarantee you a job and making such and such a year. And I remember the numbers being like 20,000, 25,000. And you look back on that now, and that salary is not good. I remember my dad telling me that in the early 70s, when he was getting out into the workforce, that I think his first job he made like $6,000 a year, and that this was a trained engineer with a relatively high level profession. And yeah, so those numbers obviously have just exploded dramatically. And what I'm trying to do with this population adjustment here is to figure out, is our wages really keeping pace with this? Is your net worth keeping pace with this? So this is not going to be a representation of wages, but this should be somewhat related to net worth. So I wonder what happens if we add the working age population and the retirement age. So I'm going to see if I can find a retirement data series here. Let's see. Let's say senior population. Let's try that. Net percentage, domestic banks. That's not exactly what I wanted. Let's look at population. All right, let me pause the video here and I will do a little bit of searching. Okay, I was able to figure it out. I had to combine two different data series here, total population and population over 65, because that one's only in percentage, so we got to multiply it out. Is what it is. Okay, yeah, let's find that. And the reason I'm doing this is because kids don't have money, so try to exclude that. So let's add pop, which is the total population. That's going to be line C. And then the other one was SPPOP 65, whatever. Let's add that as line B. Okay, now what do we need? So instead of just dividing by B, we're going to divide by B plus C times 1,000, because that's represented in thousands, times D divided by 100, because it's in percentages, but it's an integer number representing a percentage. So you actually have to divide by the 100 to get it into percentage to multiply by the total population. All right, so let's apply that. Okay, and we lose some granularity on the data because it goes down to annual, but fair enough. So now we are at 81,000 per person 15 and above. So we're excluding the kids 14 and younger. We're saying per person in the United States, 15 and older, what is your share of the money supply on average? So obviously people are going to have more, people are going to have less. There's a Pareto distribution probably in most things. And that's super interesting. When you're projecting out, what is the growth rate here? So let's take a look at that. So let's see, can we do this in a log scale? It's natural log. Okay, so we're getting a flat-ish line, which in logarithm terms means that we are at a smooth exponential. So what is that smooth exponential? Let me do some math real quick. Actually, forget the math. I think I can just do it here. So let's do continuously compounded rate of change. Okay, so yeah, let's call that, I don't know, 4%, 5%. Here's the inflation of 2020. Over the last 30 years, 40 years, yeah, we're probably somewhere in that 4 to 5% range. So in terms of inflation, like the actual monetary inflation, it's closer to 6%. But because the population is growing, that's ameliorating that on a per person basis a bit. And so we're looking at 4.5, 5% personal level inflation, which is in line with what we're seeing or what we've felt, I think, over the last 20, 30, 40 years. But we can see that if we look at the absolute number, it's just over a working lifetime, 40 years. So that'd be 1983, 11.7 up to 81. That's an enormous growth. What felt normal in 1983 costs a lot more now. So 81 divided by 11.7, 81 divided by 11. So basically a sevenfold increase. So if we're looking over the next 40 years, if you're a young person and you're saying, I have a 40-year time horizon, what's my ending number based on investment rates and all that kind of stuff? Then you got to discount that by a factor of 7, assuming these historical rates remain somewhat similar, which I think is probably reasonable. And so if I end up with $2 million in 40 years, it's going to feel like 285,000 today. And that's worth thinking about because 285 does not buy you the same stuff that 2 million does. Yeah, when you're looking at these very rosy investment projections, you got to keep in mind the inflation and then now adjusting it a on a per person level so that it's narrowed down to the individual experience. 40 years, factor of 7. Okay. And if we're looking at just year over year, call it 4.5, maybe 5%. So 1.05, if we raise that to the, I got to do the complicated calculator. Let's do the scientific 1.05 to the 40th power. So get us close to 7.03. There we go. So right around 5% personal level inflation over the last 40 years, probably going to be similar for the next 40 years, assuming we don't have a whole monetary collapse or anything like that. And that is higher than the official measure of inflation that you look up. And that difference, it might seem small because you might see like, oh, 2.8% versus 4%, 4% versus 5%. When you compound these things over decades, makes enormous differences in the end. I hate to say middle-aged now, and I'm halfway through a working career, 40 years, 20 years behind me, 20 years in front of me, roughly. It's even over that shorter time frame, these numbers make a difference. Whatever you're doing to save and invest, and keep in mind those are two separate things, saving and investing. People like to lump them together. It's still numbers you should factor into your projections. That was my idea that struck me this morning, and I'm glad it actually worked out in the math. All right, that's it for this one.